Welcome to the Value Investing online course by myvaluepicks.com. We have designed this course based on successful investment strategies from value investors like Benjamin Graham, Warren Buffett, Charlie Munger, Peter Lynch, and Howard Marks. At the end of this module, you will learn why invest in stocks, the magic of compounding, investing does not equal trading, and how to research a company. Stock markets are volatile. Why should one invest in stocks? What are the different types of investments? Let's look at four main asset classes that investors can choose from: real estate, gold, fixed deposits, and stocks. Real estate is a hedge against inflation. Historically, real estate has given a return of 10 to 12% per annum. In major cities, property prices have come down since 2010. Historically, stocks have outperformed real estate. The selling of real estate is not easy. Gold is a safe haven, or a hedge during recessions and bear markets. Gold tends to perform better than stocks during recessions. Over the last 15 years, gold has outperformed stocks and bonds. Over a 30-year period, from 1990 to 2020, gold has moved from rupees 212 per gram to rupees 4,960 per gram. India's long-term interest rate is around 6% to 8%. India's long-term inflation rate is also around 6% to 8%. Fixed deposits fail to beat inflation by a margin. Stocks have outperformed fixed deposits over the long term. Stock prices never go up in a straight line. Many retail investors lack patience when it comes to the stock market. Over a 30-year period, from 1990 to 2020, BSE Sensex has moved from 775 to 39,500. Over a 30-year period, stocks have outperformed real estate, gold, and fixed deposits. It is important to consider the time frame of your study when you compare asset classes. Generally, the stock market is more volatile in the short run. Stocks can take a big hit during recessions. Volatility can be caused by various reasons, such as Great Recession, financial crisis, pandemic, geopolitical, and company-specific events. Risk can never be ruled out in stocks, but a long-term investment approach can minimize it. However, if you consistently pick stocks that decline in value over time, you will lose money, even if you are a long-term investor. To be a successful stock investor, you must learn to pick the right businesses at the right price, and avoid the ones that are not right for you. Sensex has gone from 3,000 to 6,000 to 4,000, to 21,000 to 8,000 to 42,000, to 26,000 to 40,000. Volatility gives you an opportunity to buy quality stocks at fair valuations. Warren Buffett said, "Look at market fluctuations as your friend, rather than your enemy. Profit from folly rather than participate in it." Stocks are one of the many ways to invest your money. Why choose stocks over other options like real estate, gold, bonds, or fixed deposits? Most investors invest in stocks because they provide the highest potential returns. Stocks have outperformed all asset classes over the past 20, 30, and 40 years. Indian stock market has averaged a 15% annual return on investment over the last 40 years. If you had invested rupees 1 lakh in the share market in 1980, those shares would be worth rupees 2.68 crore today. The decision to invest in stocks or real estate or gold is a personal choice, depends on your risk tolerance and investment time frame. As Warren Buffett puts it, the more you learn, the more you will earn. Why is compound interest important to stock investing? Let's find out how to use compound interest to your advantage. Most of us learned compound interest in school. But do we apply it meaningfully to our investments? Compound interest is called the eighth wonder of the world, because of its magical powers. As Albert Einstein said, compound interest is the eighth wonder of the world. He who understands it, earns it; he who doesn't, pays it. Two things will influence the rate at which your money compounds. They are number of years, and rate of return. Say you start investing rupees 2,500 a month for 30 years. You would have invested a total of rupees 9 lakh. Assume that this investment grows at an average of 15% per year. At the end of 30 years, it would be worth rupees 1.5 crores. At the end of 35 years, the same investment would be worth rupees 3 crores. At 15%, you could double your investment every 5 years. The longer you leave your money to compound, the higher is the wealth you generate. The rate of return you earn from investing is also crucial. The higher the rate, the more money you'll have later. A few percentage points in interest rates can make a huge difference in future wealth. History has proven that even though stocks are volatile, they are the only investment vehicle that can give more than a 15% return in the long run. Please refer to the table to see how an investment of rupees 1,000 per month will grow in 25, 30, and 35 years. Your investment time frame and the rate of return have a significant impact on your investment. Why 72 is the magic number when it comes to doubling your money? The rule of 72 is a simple way to estimate the time it takes to double an investment. If you want to know how many years it would take for an investment earning 12% to double, divide 72 by 12. The answer is 6 years. The reverse is also true. If you want to know what interest rate will give you double the money in 4 years, then divide 72 by 4. The answer is 18%. To use the power of compounding most effectively, you should start investing early. Invest as much as possible. The rate of return you earn from investing is crucial. The higher the return, the more money you will have later. While stocks are volatile, the rewards can certainly outweigh the risks in the long run. Why investing does not equal trading? Let's find out the difference between investing and trading. Different people have different perceptions about the stock market. Some people make money by creating a liquid market for stocks, and actively day trading. They have to spend an incredible amount of time tracking their stocks. When you are day trading, two factors work against you. First, the trading commission will take its toll on you. Second, you have to pay taxes for short-term gains. Investing is a long-term game. Investors need to practice, buy and hold. Charlie Munger once said, "It is remarkable how much long-term advantage people like us have gotten, by trying to be consistently not stupid, instead of trying to be very intelligent." Imagine you own a house, and receive a decent rent from a good tenant. You would not sell it to make a profit from a real estate boom. Similarly, if you own a franchise business, and it is running successfully, you would not think of buying and selling it every day. You understand the long-term benefit of owning a house or a business. The same logic holds good for shares. When you own stocks, you own pieces of business. You can pick the best companies in the world, and invest in them through shares. You've got people running it for you. You know it is going to do well in 5 to 10 years. Buying or selling them based on current news would be a terrible mistake. What if you had invested rupees 1 lakh in MRF shares 25 years ago? Investing is all about patience. MRF share price moved from rupees 11 in 1993 to the current price of rupees 58,500. Rupees 1 lakh invested in MRF shares 25 years ago, it is worth rupees 53 crore in September 2020. Trading and investing are two different activities. Traders focus on the price movements rather than the company's fundamentals. Investors are those who buy stocks at an attractive price with the belief that the company has long-term prospects. Let's find out how to research a company, and how to get the most out of a company website. A good investor should always know what he is buying. Research the company before investing any money in its stock. You will learn a lot about a company by reading the following reports regularly: annual reports, investor presentations, annual report analysis, initiating coverage reports, primary research reports. To gather information about the company, visit the company website. It will have a section called Investors or Investor Relations, where you will find annual reports, financial statements, and press releases. You will find most of the information in the annual reports. They will be available in PDF format. Some company websites may have investor presentations. They are more useful reports. Reading the press releases will give you the most up-to-date information. You will find the following reports on the company website: Annual reports, Investor presentations, Quarterly results presentations, Financial statements, Earnings conference call transcripts. Thank you for your interest in the Value Investing online course by myvaluepicks.com. If you liked the video, please hit the like button. If you want to see more videos, hit the subscribe button, and if you have something to say, please leave a comment. Please read the following terms and conditions carefully and completely.